Benefit Services. I'd like to thank everyone for joining today's webinar. Today's topic, we're going to be covering the subject of investing in your self-directed IRA or 401k in the product line, which is known as life settlements or fractional life shares. Today's guest is going to be Mr. Ken Morris with Reliant Life Shares, a very experienced and knowledgeable individual when it comes to investing in this product, which is known as an insurance product, but this structure basically allows you to use a self-directed or retirement accounts to invest in this investment vehicle. Today's discussion basically it'll be recorded. We'll basically have a Q&A session towards the very end, and within the next 1 or 2 business days, we'll be sending out a recording of this webinar for you to listen at your leisure, as well as to pass this along to others who may be interested in this investment product. As I mentioned, we'll be covering the Q&A session towards the very end, so you'll be using your chat feature to enter your questions, and at the very end of the presentation, we'll start to answer those questions. Any questions that we will not have time to answer, feel free to give us a call or contact us via email, and we'll be happy to answer any questions you have relative to the product. What we'll be covering in detail today is, one, what is a life settlement? What is the structure of the product? How did it come about? And what types of investors are you actually investing in this product? We'll also talk about how to invest in life settlements using, once again, the self-directed IRA or 401k, whichever you choose, depending on whether you're employed or self-employed. We'll compare the traditional investments to life settlements, and also looking at some of the other alternative investments to kind of give you an idea how this product line up to other investments that you may not more likely have access to if you have a traditional retirement account that does not allow you to invest in alternative investments. We'll learn the difference between a life settlement versus a viatical. It's a product that was around during the AIDS crisis, which is no longer around just based on some of the cures that's come around, but this is a totally different product. And we believe that based on this product, it's a win-win situation for both the person who actually sells the policy as well as the investor involved. It's a win-win situation. The structure of a life settlement, we'll talk about the structure of the life settlement and the investment process as it relates to using self-directed funds or using private funds or a combination of both to invest in this product. So without further ado, I'll go ahead and turn this over to Mr. Ken Morris. Ken will go ahead and give you a quick overview in terms of what we're going to talk about his background and what we'll be covering today. And once again, towards the very end, we'll do a Q&A session after I perform my portion of the presentation talking about the self-directed IRA and how it ties into this type of product. Okay, go ahead, Ken.
Okay, Lamarr, thank you very much for the introduction. Ladies and gentlemen, I'm happy to be with you here today. I've got our operations analyst with us today, Mr. Corey Weiss. I'm going to introduce him here just shortly, but give you a little background on myself. I've spent about 20 years in this asset class. I have raised several $100 million from investors, both on the institutional side and the qualified individual investors as well. Back in the 1990s, I authored and trademarked the first training course of its kind. I had trained close to about a little over 1,000 representatives from 1999 to 2004, and I was responsible for hiring and training and training these registered investment advisors. Opened up my own life settlement broker company back in 2004. By 2006, I created a company that was what they considered to be a life settlement provider company. We had dealt with a company, a bank, one of the largest banks over in Germany. We ended up transacting a $225 million revolving line of credit to purchase up these assets. And over the next couple of years, we had purchased well over $1 billion worth of life settlement contracts. Those life settlement contracts were put into portfolios, securitized, and sold in 25, 50, and $100 million blocks to about to a number of corporate banks that were associated with this German bank. Today I am the Director of Business Development for Reliant Life Shares in Los Angeles, California, and today I take on the role of hiring and training registered investment advisors, insurance advisors on this asset class. And so what I'd like to do right now is introduce our operations analyst, Mr. Corey Weiss. Corey?
Yeah, hi everyone. My name is Corey Weiss, and currently my role is as operations analyst here at Reliant LifeShares. A little bit about me and my past. I also, like Ken, I'm a seasoned veteran of the financial industry, but not all of my 20 years have been in the life settlement asset class. I started out back from 1993 to 1998, basically as a financial advisor back in New York, which is where I'm from, specializing with working with seniors and doing a lot of estate and long-term care insurance planning. Then I was fortunate to have a good friend of mine who was trading on Wall Street during the internet heyday, and so I kind of went down there and I traded on Wall Street from around 1998 or so to 2005. Got a lot of war stories about that, but that was very, very interesting and great. And then for the past 8 years or so, before coming aboard on Reliant about 5 months ago, I've been a life settlement broker, which basically combines the trading and the insurance aspects of what I'd done previously. So for the past 8 years, my role, I had my own company, and primarily what I did was I went out there and I helped seniors who wanted to sell this asset in the market. I helped them sell it in the secondary market and got bids from all different providers, like Ken was saying, and basically worked for them and got them the best bid in the marketplace and closed the transaction. And that's what I've been doing for the past 8 years, specifically in this asset class. So,
very, very good, Corey. Thank you. So let's get on with the PowerPoint presentation. The first slide that you see here is think about what investments that you have owned over the past decade, and what investment products that you have owned in this portfolio have returned an average of 12.5% over the past decade. When we ask this question to investors, and if you're like most investors, the answer is none. There's not a product that is out there over the last decade that I know of that has given an average annual return of about 12.5%.
Yeah, and you're right, Ken. And the truth is that most retail investors just don't know about this asset class. They're just not aware of it. But it's been out there for a long time, which we'll get into in a minute. And many of the institutions who purchased the policies that I brokered have enjoyed returns like this for well over a decade, and we'll get into that.
Well over a decade, absolutely. So, are you skeptical about investments that claim that they can provide higher rates of returns? If not, you ought to be, until today. So what we're going to talk about today is one of the best kept secrets in the financial world. You'll find out that companies like Deutsche Bank, Credit Suisse, Merrill Lynch, Goldman Sachs, Wells Fargo, even Warren Buffett's company, Berkshire Hathaway, have invested not just millions, not just tens of millions, but hundreds of millions, and literally some of these companies have invested billions of dollars over the last decade investing and buying up this asset class. It's backed by some of the largest financial institutions in the world. And with our asset class for individual qualified investors, it's paid by one of the oldest banks in the United States. And we're going to get into that in a couple more slides. But let's look back over 100 years ago when there was a U.S. Supreme Court case. It was called Grigsby versus Russell. And in this case, a life insurance company actually refused to pay out the death benefit proceeds on the grounds that the policy had previously been sold to a third party who had no insurable interest in the insured. It was a doctor-patient relationship. The patient needed an operation, couldn't afford the operation. The patient ended up signing his life insurance policy over to the doctor for him to perform the operation. A year later, the insured died. The doctor filed the death certificate with the insurance company, and that's when the insurance company refused to pay out the death benefit proceeds. He fought it. It went all the way up to the Supreme Court, and it was where the Supreme Court ruled in favor of this new owner. And they made it law that anyone who owns a life insurance policy has the right to sell the policy to a third party. They can change the beneficiary designation. They can borrow against the policy, and they can also assign the policy as collateral.
Yeah, and I'm glad you mentioned that, Ken, as well, because as a financial advisor, I frequently saw many transactions where a client, for example, would have to move a life insurance policy over to a trust to do some planning, or a corporation to do some planning, or maybe they were leaving a corporation, and the corporation would transfer the insurance to them. So, it's not just for life settlements, but this 1911 Supreme Court decision really laid the basis for some sound financial planning as well. And without it, life insurance wouldn't be property, and you couldn't transfer it to trusts and corporations and anything else. So,
yeah, absolutely.
Thank goodness this happened.
Absolutely. But see, what happened in this 1911 Supreme Court case when the insurance companies lost their battle, they didn't send out and notify all of their insureds that if you have a life insurance policy, that you could turn around and sell that to a third party. They didn't give you any of that information. So it truly has been one of the best kept secrets in the financial world.
And as life settlements gain steam again, like we said before, this has been kind of a privileged investment for institutions for a very long time. But now, and we may cover this later, but now what you're seeing is many states, when a senior goes to surrender their life insurance policy per the NCOIL Model Act, which was an act that was passed a few years ago, many states are now required to notify that senior that, hey, listen, you have another option. Instead of cashing this insurance policy in, which we'll cover in a minute, there is a secondary market out there, and you may be able to get more money for this policy. So that's actually a state requirement in many states now, and more states are subscribing to this and coming on board with that.
So it's really a life insurance policy you can use as a true estate planning tool today. So the question is what is a life settlement? A life settlement is a financial transaction simply where a policy owner, and they're usually 75 years of age or older, they sell their policy to a third-party investor. And again, those third parties, again, Corey, was Goldman Sachs, Merrill Lynch.
Hathaway. We just had Apollo, Leon Black's group, Apollo Capital Management, the big private equity firm. They recently, in August, purchased another $600 million portfolio. McKinsey just purchased a $135 million portfolio of policies. There's a whole market out there, and there are a lot of trades going on. It's just that the retail investor is just not privy to this information.
Right. Well, Warren Buffett, they just picked up another $300 million portfolio.
Yeah.
So anyhow, so they've been selling their policies in this asset class for well over a decade now, and these insureds are selling their policy for more than the surrender value, oftentimes 4 times larger than the surrender value. The investor, the new investor, then becomes the new owner and beneficiary of the policy, and they take full responsibility for servicing the policy. Now, we're talking about institutional investors here. They take full control. They're going to go ahead and they're going to track and monitor the insured. They're going to pay all the future premiums on the policies until the insured meets their demise. Then they're going to file that death certificate with the insurance carrier. Thus, the insurance carrier will then pay them the proceeds. Good to know that there's never, ever been an insurance company in the history of this country that has ever failed to pay out on a legitimate death benefit claim, ever. So why do seniors, the question comes up oftentimes, why do seniors really want to sell their policies? Well, seniors are selling their policies today for a whole host of reasons, mostly because they no longer need, nor want, nor possibly can afford. So seniors use these proceeds when they sell their policy to live their remaining days with dignity. The policies that we buy from seniors, they're not the Betty Whites of the world that are running on, they're not jogging 5 miles a day or whatever.
Right.
They're not on a treadmill. These insureds that we're buying policies from have chronic illnesses, heart disease. They have cancer.
Yeah, and I'm glad Ken brought that up because when I was trading on Wall Street, we often look for arbitrage opportunities, and really that's kind of like what we look for here as well. Typically an insured might have bought a policy when they were healthy at age 70. Now they're age 80. If they were to go out and buy a policy today, they certainly wouldn't get the policy at standard or preferred rates. They might not even be able to get a policy at all. So typically the investor will be paying premiums on someone who's healthy at a younger age. But the true, health of the insured at that point may be a lot worse. Mm-hmm. So that's kind of a little arbitrage situation that we look for when we buy policies.
So let's give you an example here. Let's say we have an 80-year-old male here. He has a $2 million life insurance policy, and he's been paying these premiums on the policy for, let's say, 5 or 6 or 7 years. The premiums have actually escalated to $100,000 per year on the policy. And the surrender value inside that policy has a cash surrender value of, let's say, $50,000. Now, here's a typical example where a senior has got a life insurance policy that the premiums have escalated to $100,000. He no longer can afford to pay these premiums. Maybe because he got hurt in the market in 2001, and then he got slammed again in 2008.
Yeah, that's what I saw in my business. I would say 80% of the policies that I saw were distressed. They may not have paid premiums for a few years,
right.
Very, very little cash value, and they're coming to me because they have a problem. This policy is going to go away. unless they make a huge payment to the insurance company and continue payments. And that's when they come to us.
So what are the options for this insured? Well, prior to everyone knowing what a life settlement is, and this is where Corey had mentioned where many states are now enacting these laws where it's the insurance advisor's fiduciary responsibility to inform that insured that they have an asset that can be sold for more than the surrender value in the secondary life insurance market. So let's look at the options here. One, this insured can continue paying the expensive premiums, but he can't. Go ahead,
well, if he can. Most of the policies that I saw, they can't.
Right.
So, it's an option, I guess.
Right. Now, he can also take the cash surrender value to help pay the premiums. But in this example, here's a $100,000 a year premium. He only has $50,000, so the $50,000 is only going to cover him another 6 months.
Yeah, I had someone call in recently and ask about a policy and what they should do, and I told him, he had enough cash value to probably keep that policy going for about a year or two, which is fine. He can certainly do that, and that was probably the best thing in that situation.
Right.
But often these policies are just distressed, and there's just not enough money to pay from the CSV. So.
Right. So the surrender, you can surrender the policy for the cash surrender value and take the $50,000, and that's what's been happening over the last 150, 200 years. People have been taking their surrender value. Now there's the option to sell this as a life settlement and receive up to 4 times. When we look at a policy, the shorter time someone has remaining with a life expectancy, the more they're going to receive. Someone who has a longer life expectancy, the less they're going to receive. But still, the arbitrage is there. It's going to be more than the surrender value. And so you can really see where this is an asset that can be used as a living benefit versus just a death benefit. So let's move on here. Who has invested in the life shares in the last decade? Well, we've been telling you about Merrill Lynch, Goldman Sachs, Credit Suisse, Deutsche Bank, even Warren Buffett's company, Berkshire Hathaway, has invested billions of dollars into this asset class. They have consistently received historical double-digit fixed returns with no market risk. Now, because Reliant Life Shares has an asset class that has been designed for the private qualified investor, we are now bringing in doctors, CPAs, attorneys, small business owners, and other qualified California investors who are really looking to protect their principal in their portfolios and their retirement plans like their IRAs, their SEPs, their 401k plans.
Yeah, and a point I want to make too is, what you have to understand is these institutions have been investing for a long time, and only really because they have the wherewithal to do it. I mean, if an investor came out and said, I want to invest in life settlements, what would an investor do? He'd have to find a policy, he'd have to price it correctly, he'd have to make sure that there was an arbitrage situation, he'd have to make sure that the premiums to face amount was correct. There's a lot that goes into this. He'd have to make sure the carrier was a well-rated carrier. He would have to get the beneficiaries to sign off, make sure the insured is of sound mind, structure the trust agreement. I mean, the list goes on and on. So the medicals and the life expectancies. So really all we do as a company, because we have, over 50 years of experience, combined experience in this asset class, all we really do is provide the knowledge, expertise, and framework for qualified investors and retail investors to participate in this exclusive class. So
yeah, you can consider us like a real estate broker. We put the buyers and the sellers together.
Yeah,
basically. And so we'll go over the structure. But first, you want to look at this, as many of our investors do, as a compassionate and philanthropic investment. Warren Buffett has pledged to give away 99% of his fortune to charitable causes. He's also been philanthropic. Perhaps this is the reason why he's invested so much money, tens of millions, hundreds of millions of dollars, into this asset class. And it's not that he's just starting to invest in this. He's been investing in this asset class for over a decade now. So,
when I look at different investments and I look at a stock or a bond or a commodity, I can't think of anything where you're actually helping someone.
Yeah, absolutely.
Really, I mean, can you think real estate? I mean, maybe if you're selling someone, but basically, this investment, you're actually helping a senior who typically needs the money.
Yeah, it's definitely philanthropic. Yes.
So.
Yeah, and I mean, this gives you peace of mind as well. So the truth about life insurance. There's $20 trillion in life insurance policies in force today. $20 trillion in life insurance. The American Council of Life Insurance states that 88% of all UL policies, that's universal life insurance policies, will lapse be surrendered and never paid out on a death benefit proceed. So if you look at this, you're looking at a product that the insurance carriers have built to really fail the end user. I mean, they've never failed to pay out on a death benefit proceed since, what is it, 1756, something like that, right? So that's great, but they've actually built a contract where you'll sign it, and you'll make premiums, and the older you get, the more expensive the premiums become. This is why people have either lapsed or taken just the cash surrender value when they no longer need it, nor want it, or possibly can't afford it.
Yeah, in fact, there's something called lapse-based pricing, which is how a lot of these companies actually, they actually price their premiums knowing that 88% or whatever the large percentages will fail and come off the books. So this is kind of the dirty secret of the industry that no one really talks about, but this is the truth about life insurance.
Right. So if you think the 88% number is relatively high, look at the numbers on term policies. Now, these are not our numbers. This is the American Council of Life Insurance that states that the numbers are even higher on term policies with a lapse ratio of 99%. There's an average shelf life of life insurance policies is approximately 7 years. So people go through hills and valleys, financial hills and valleys in their life, and every 7 years it seems something changes. And, you know, again, this is just a typical shelf life of a life insurance policy that stays on the books. And again, I really can't stress that insurance companies make more money off the lapse policies than they do off their own investment portfolios. Let's look at some regulations. In California, investments in life settlements are considered securities. They're regulated by the California Department of Business Oversight, and this is not anything new on their books. This is well over a decade ago. I think it was, it was right here, August 2000. It's called Senate Bill 1837. We have that on our website. You can look more into that as well. But only a registered securities advisor would be able to sell you this product, or a California life insurance advisor would be able to sell you this investment class. So the existing laws, you want to mention on that?
Yeah, I mean, basically the Senate Bill 1837 amended the Corporate Securities Law of 1968 in California. And basically what it says is that the law, it prohibits the offer of sale of securities such as stocks, bonds, or anything like that, unless the sale has been qualified or an exemption from qualification exists. And with life settlement investments, a qualification, an exemption does exist. So they don't have to qualify to be registered as securities. And a licensed life agent can, in fact, sell this in California.
So we've had numerous studies that have been done over the years. There was one that was done by Wharton School of Business. It's one of the most prestigious business schools in the United States, the Wharton School of Business. What they did back in 2002, they took 1,584 policies on seniors, and they compared them with the difference between what the insurance companies were willing to offer those insureds for their cash surrender value. On 1,584 policies, it equaled, the surrender value was $93.4 million. However, in the secondary market, the insureds would receive much more. What they evaluated was that the life settlements those same life insurance policies, had a value of over $336 million, which is over 360% more than the insurance companies were willing to offer them. There was another study that was just released recently. There was a London School of Business, and again, in London, this London School of Business is similar to our Wharton School of Business. It's in all of Great Britain. It's one of the most prestigious colleges as well.
Yeah, it's the Harvard of Europe, I believe.
Yeah,
yeah,
it
it's
is.
Harvard of Europe.
Yeah. So London School of Business, what they did was they did a 10-year study on over 9,000 life settlement cases, and what they found was pretty much what the Wharton study had found out back in 2002, that the surrender value that the insured would receive up to 4 times.
Yeah, I mean, the London study basically confirmed the Wharton study with respect to the amount that the senior could expect to receive in the secondary market, which is what we've been talking about, thus far. And I think now what we're going to get into is probably more what our audience is interested in, which is the investment returns that the institutions have gotten and that retail investors can now anticipate by actually participating on the investment side. So let's talk about that.
Okay, let's talk about that.
So yeah, the London study basically concluded that over their 9,002 policy sample, okay, any investor who invested in those policies could have expected to earn an annual return of 12.5% per year over that 10-year period, which goes back to our first slide, okay, with a low of 11% for 2005, 2006, and 2007, and a high of, the actual high was 18.9 in 2001, and a recent high of 18.3% in 2011. And this is over, the stock market going down in 2008, the financial crisis. Life settlements are uncorrelated to movements in markets because you just own a life insurance policy on someone. So whether, the government defaults on debt or Detroit goes bankrupt or the stock market crashes or oil goes through the roof or gold goes down or up, it doesn't matter. You own an asset class which isn't correlated to any of those things, essentially, which is really why a lot of the institutions like this asset class, because so much of what they do is dependent on markets and what the markets do.
Yeah, this is definitely uncorrelated. I can tell you, ladies and gentlemen, we're not getting out alive. We're all going to get there. So let's look at some of the benefits that investors enjoy with our asset class, and we'll keep going on with this. First off, there's no stock market volatility. As Corey just mentioned, the stock market could plummet for the next 2 years. It wouldn't affect our asset class one iota. In fact, in 2008, when the market dropped 53 points, 53%, excuse me, 53 points, 53%, our asset class kept going up. It was not affected by what the market was doing.
Yeah, according to the London study, it had to do at least 11% because that was the low during that period. So I don't know what it did that particular year, but it had to do at least 11.
Right, it was
uncorrelated.
Yep, yeah, uncorrelated. So what you also, one of the other benefits is predetermined double-digit fixed return on your investment capital. You put in $100,000, you know right up front what your end result is prior to investing $1. You put in $100,000, we have a 5-year projected life expectancy on an insured. That policy matures on time. That's 100% fixed return that we offer. So the $100,000 thus becomes $200,000 in projected 5 years.
Yeah, in that example, I mean, every policy that we bring on is structured differently only because we buy it at different points and we have to structure the transaction to benefit investors. So not every policy is going to offer 100% fixed return, but that is typical. Yeah. Typically, 85, 125% fixed return. So in that situation, an investor investing $100,000 at 125% fixed return would be getting $225,000 when the policy matured.
Absolutely. That's how that works. Another good benefit is that this asset class is regulated by the California Department of Oversight. We have short estimated maturity options available for your IRA, your 401k plans. You can invest in 2-year, 3-year, 4, 5, 6, 7, and 8-year contracts. You can diversify across multiple policies to mitigate the risk and enhance your returns. It performs in any economic condition or geopolitical climate, and that's what Corey and I have really been focused on with our investors.
Yeah, I had an investor call in a few weeks ago and say that this is when the whole Syria thing was going on, and he said, you know what, I love this because I can sleep at night. I really don't care. I don't have to be watching CNBC all day or on my phone checking E-Trade to see how much money I have.
Absolutely.
It's a good point.
Yeah. So you can grow your funds tax-deferred, or if you have a Roth, you can grow them tax-free. Another benefit is it's backed by some of the world's largest financial institutions, and let's just touch base on that. Who are these financial institutions?
Well, I mean, we only work with
A or
better rated insurance companies, typically by Standard & Poor's, AM Best, the ones that you've heard, the rating agencies that everyone knows, Moody's and all that. But typically Transamerica, John Hancock, MetLife. I mean, when you hold a certificate saying that you own a portion of a policy, you own, MetLife paper, John Hancock paper.
A or better rated.
A or better rated paper, so yeah.
Paid by one of the oldest banks in America, and we're going to get into that in the next slide, and I'll show you what I mean by it's being paid back by one of the oldest banks in America. We have an unbeatable track record over 150 years. Now, Reliant's not 150 years old, but we have insurance carriers that have never defaulted on on a death benefit proceed. So it just doesn't happen. So let's look at Christiana Trust. Christiana Trust is a division of a publicly traded bank, Wilmington Savings Fund Society out of Delaware. And if you want to look up their symbols right here, it's WSFS. They were founded back in 1832. They're 181 years old this year. And again, one of the 7th oldest continually operating banks in the United States. And also, as of September of 2013, they oversee $5.6 billion in assets. Go ahead, Corey.
Yeah, and that's really relevant, and we're going to get into this. You know, who is Christiana Trust and why does that matter? Well, essentially, they're the ones that are going to hold investor money, and Ken's going to get that now. So
right. So what happened, here's how the transaction works in 8 simple steps. 1, the Reliant Life Shares will go out and seek and acquire the life insurance policy. We have a licensed advisor that presents the opportunity to investors like yourselves. And what they do is they select from a group of policies that we have. They actually go through and they, go ahead, Corey.
Yeah, no, basically we have a portfolio of policies, and typically the advisor meets with the client. They talk about risk level. They see what's appropriate, what's not appropriate, and they would select the policies for the investor to invest in, that the investor would select.
Absolutely.
Yeah.
So it's not like you're investing into a blind pool and you don't know what's in there. You actually select your own policies. Once you've selected the policies, the investor docs are completed, and the funds are placed into a subscription escrow account held by Christiana Trust for benefit of all investors. The investors receive a beneficial interest certificate from Christiana Trust guaranteeing them their ownership in the policy that they selected. Oops, sorry, we'll go the wrong way. Now, Christiana Trust will go ahead and pay all the premiums out of a premium reserve account that's set up specifically for that policy and that trust.
Yeah, and the important thing here is that, Reliant doesn't have access to any of these accounts.
Right.
These are all held in a separate trust for the benefit of investors. So even if something happens to Reliant Life Shares, the investors, basically still own a beneficial interest in that trust, which owns the policy.
Yeah, Reliant could go out of business today. Yeah,
well, yeah, I mean, that's the big takeaway here is that, in fact, we often have investors wire the money directly to Christiana, because it's going to go to them anyway.
Yeah,
so.
Absolutely.
Yeah.
So, and the next thing, when the insured meets their demise or passes, it's the insurance company that'll pay Christiana Trust the proceeds from the insurance policy. Thus, Christiana Trust pays our investors their pro rata share of the premiums. Proceeds, yes. And then, sorry, thank you. Yeah, and go ahead, Corey.
No.
No. Oh, okay. Very, very good. So that's it in 8 simple steps. Very easy transaction. And our questions to our investors are: would you invest your IRA funds if your investment was backed by the world's largest financial institutions, some with higher ratings than the U.S. federal government? That answer usually comes back 99% of the time. Absolutely. Yes. Would you also invest your IRA funds if one of America's oldest operating banks in the United States was to pay you directly? Absolutely. It comes back as a yes. The third question, would you invest your IRA funds if the investment would perform in any economic climate, regardless of what happens in the stock, bond, or commodities market? That always comes back as a yes. Would you invest your IRAs if you knew that there's never been an insurance company who's ever failed to pay out on a legitimate death benefit claim? And would you invest your IRA funds if you knew exactly what the future value of your investment was going to be prior to investing any money whatsoever? Imagine investing in a stock today, Corey, and I'm buying 100 shares of Google, and I knew I'm buying it at 59, and I knew in 5 years it would be worth $1,000 today.
Amazing. Yeah.
Wouldn't that be great?
Yeah.
Well, this is one of the big benefits that Reliant Life Shares offers their investors.
Yeah, and we work, 80% of our business, we work a lot with financial advisors who have clients, and a lot of them really, really like that because they tell us, listen, this is so good for retirement planning because we can actually plan instead of a projection and saying, well, if the stock market does 8% a year, we're projecting that you'll have X amount. This is not a projection. you know, this is just something that is going to be some certain return and some certain amount that will be in the future. So a lot of advisors tell us they like that because it just makes retirement planning easier for them.
Yeah, so. Absolutely. And the last question, would you invest your IRA funds if you could potentially double your investment every 5 years without having any downside market risk whatsoever or any global turmoil whatsoever? So that's the questions that we ask all of our investors, and undoubtedly they all come back as yes, yes, yes. There's 6 yeses there. So to receive more information on how you can earn double-digit fixed returns on your IRA or 401k, you'd like a brochure, you'd like to see a recap or let's say a 24-minute DVD, or have a private one-on-one call with either Corey or myself, or you need website information, please contact our offices at 818-788-1904, extension 17. You can ask for Ken Morris or Corey Weiss. And at this point, I'm going to turn it back over to Lamarr. Lamarr?
Guys, this is a great, great presentation, and this is something that we advocate in the self-directed IRA industry is really, truly diversifying your investment portfolio, looking at asset classes that's going to protect your principal. I mean, principal preservation is something that is key. I know a lot of our clients are investing in real estate, which is, let's say, one of the #1 asset classes, but our clients are also looking for other alternative investment vehicles that they can put their money into. And once again, the key is principal preservation. I mean, although this is not considered a tangible security, it's something where, once again, there's a predetermined return on your investment that you're going to get. Something, once again, that's not affected by the global and political environment that we are all basically subject to nowadays. So once again, great presentation. I'm sure there's going to be a lot of different questions and some great questions that I'm sure is going to make this as interactive as possible in terms of getting more information out to the listeners on this. Once again, my name is Lamarr Baxter. I'm the Director of Business Development with AccuPlan Benefit Services. So what we're going to talk about now is looking at the life settlements as it relates to using a self-directed IRA. And once again, looking at the investment vehicle of an IRA or 401k to make this investment into life settlements. I didn't actually cover the disclaimer earlier. Once again, our objective at AccuPlan is to provide education and not financial or tax advice. So once again, you definitely want to make sure you consult with your tax and or legal professional before entering into any type of investment. Just a brief overview in terms of my background. I have over 20 plus years of financial related experience. I'm actually investing using my self-directed IRA. So unlike some of your financial planners and advisors, I'm actually practicing what I'm preaching when it comes to investing and what you know and understand using the self-directed plan. Look like I'm having some problems here with my screen moving here. So what I'm going to do here, hold on. Okay, here we go. So let's go ahead and start from the very beginning here. And once again, my background is over 20 years of financial experience. I'm the Director of Business Development. Once again, you definitely want to consult with your tax and legal professional before considering any type of investment. Once again, we provide just education. Our objective is really let you know what's out there when it comes to alternative investment classes. A little bit about AccuPlan. AccuPlan is a national company. We provide self-directed and IRA custodial and administrative services to individuals looking to invest their retirement accounts in non-traditional asset classes. We pride ourselves in expertise on low cost and quick service for directing your retirement funds into these alternative investment classes. Our staff consists of very, very knowledgeable individuals, including our compliance director, who is actually a retired IRS auditor. So once again, when it comes to making sure your transactions are compliant, we have the top-of-the-notch staff to make sure, one, that your transactions are compliant and that you're protected when it comes to any documentation complying with IRS rules and making sure that there's no prohibited transactions or self-dealing. Just some information I'd like to share with a lot of my clients when it comes to alternative investments and why a self-directed plan. Just number one here is estimated that 10,000 baby boomers per day will turn 65 for the next 20 years. And of that segment of the population, maybe 75% of the baby boomers are not in a position to be able to retire at the age of 65 and beyond. Most will be forced to continue working beyond the age of 65, facing problems such as skyrocketing healthcare costs, diminished Social Security, and other benefits that were around previous generations that may not be around for us. So it's really important that we take a proactive approach when it comes to looking at every investment class out there to be able to take an aggressive approach, but at the same time conservative approach when it comes to growing our retirement accounts. Inflation and cost of living will also be a factor when it comes to eroding our fixed retirement income. So once again, you want to make sure that you have that principal growing in the most effective and safest manner possible. It is estimated that $4.7 trillion in combined IRA and 401k funds are out there in the market right now, but only 1% of those funds are invested in self-directed retirement accounts or alternative investment classes. When it comes to looking at are you in a position to retire, it is estimated that, once again, a good 75% or more are not in a position to retire at the age of 65 and beyond. And you look at what you're going to be required, depending on where you live in the country, anywhere from $750,000 to $1 million is what you're going to be needing to have a conservative or somewhat a decent lifestyle to be able to carry you through your retirement years. So take a look at your statement. I'm sure there's something that's probably shocking and you're probably aware of as we talk about this. Most of us are not in a position based on these numbers to be able to retire at the age 65. So it's really important, once again, to take a look at all investment classes that's available to you. They say 90% of the population is unaware of a self-directed IRA and or 401k. And what a self-directed plan allows you to do is basically invest in everything besides life insurance and collectibles. And I know this topic here covers insurance, but we're going to talk about why this investment vehicle is an exception when it comes to life insurance, because you're not directly investing in the actual policy. You're basically investing based on what's called fractional shares, which is the equivalent of investing in a private placement or investing in stock where you have a fractional share of the investment, so that makes it a permissible transaction. They say 90% of the population is not aware of a self-directed IRA. That would include some of your legal and tax professionals. Once again, talking about your financial planners, most are not trained or well-versed in this area of the tax code. And just to kind of give you an idea, this is not a new concept. As part of the ERISA Act that was passed in 1974, Congress passed that in 1974, basically allowing for the use of retirement plans to be able to make alternative investment choices. Now the question comes around a lot is, well, if it's been around since 1974, why are we just hearing about it? Well, unfortunately, a lot of our traditional institutions have put trillions of dollars in terms of marketing costs towards traditional investments, some use stocks, bonds, annuities, and so on and so forth. And of course, a lot of times you're not going to hear about these type of investments because their plan agreement does not allow you to be able to invest in a lot of the alternative investment classes that you have available, such as life settlements. Your current custodian does not offer a truly self-directed IRA. And when we say truly self-directed IRA, we're looking at both traditional and non-traditional investment classes. So we look at real estate, life settlements, invest in precious metals, foreign real estate, you name it. These are asset classes that are not available through your traditional custodian because their plan agreement does not allow it. And when we talk about traditional investments, it's not to say do not invest in traditional investments. Our objective is to educate you on truly diversifying your investment portfolio. And once again, back to the $4.7 trillion in assets most invested in Wall Street, the majority of the funds are invested in mutual funds with brokerage firms. And once again, those are all traditional assets. So once again, looking back to what happened in 2008 when the market crashed, you were told prior to the market crashing that you were diversified. Well, diversification wouldn't include if you have 10 different investment products all in Wall Street and Wall Street crashes. So one of the things that's nice, once again, talking about life settlements, it's always nice to look at asset classes that have least or no effect based on some of the political and social issues, or should I say political issues, when it comes to what's going on around the world. I mean, we live in a global economy, but there are asset classes that can shield our investments from some of that volatility that's happening in the market and is happening in the world. So the next slide, we're going to talk about why a self-directed IRA. Once again, invest in what you know and understand. I like to believe that most of us have a niche or a knack to where we have a knowledge base on certain asset classes that we can really go out and do a good job in terms of using our retirement funds and investing into something more safer, secure, and something more tangible or with a pretty much guaranteed return, if not a principal preservation. These are some of the more common asset classes that our clients are using to invest their self-directed plans, whether it be a 401k or an IRA. But once again, the sky is the limit when it comes to using a self-directed plan to invest in both traditional and non-traditional asset classes. Once again, invest in what you know and understand, just to kind of give you an idea in terms of what your options are using a self-directed plan. I'm sure if you were to contact your current custodian and ask them, could you invest in any of these investment classes, I'm sure the answer would be no. And once again, not everyone is well versed to invest in every one of these different options that's available. So this is where it's really important that you either assemble a team to assist you with your investing, make sure that you do your due diligence on the investment to basically minimize any risk or potential of risk when it comes to any investment. I mean, as with anything, there's no certainties in life other than death and taxes, which is kind of funny. We're talking about lives and settlements, but that's one of the subjects that come up in terms of life settlements. Well, it's something that be considered morbid, but as Ken had indicated and Corey had indicated, this is a win-win situation because once again, if you basically are in a position to become an investor and provide a service or an opportunity to someone who can use it, especially if someone who's over the age 75 or 80, have multiple policies, but do not have enough capital or cash to carry them through their golden years, if they have 2 or 3 policies, what's wrong with them basically selling one policy and still have the ability to leave something for their loved ones and friends and relatives? So I'm sure there's challenges that usually that's going to come up, and I'm seeing some questions popping up as it relates to relatives and disputes of policies, and I'll go ahead and have Ken and Corey answer those questions when we get to them. But once again, looking at this list, you don't have this option available to you with your current custodian or traditional custodian. So it's definitely something you want to look at when it comes to diversifying your investment portfolio. So we're going to talk about prohibited transactions because I've talked about what's great. Ken and Corey talked about what's great about self-directed plans, but there are certain rules that must be followed to make sure, one, that you're protected as the investor, and also to make sure that you adhere to Department of Labor and IRS rules. So one of the rules is IRS Code 4975, which is the core rules, set of rules that basically make sure that all your transactions remain compliant, which covers prohibited transactions and disqualified persons. So basically what a prohibited transaction is in the event of any IRA that is set up cannot engage in any transaction, direct or indirect, with anyone, anybody, or anything considered related to the IRA. So some examples would be a prohibited transaction would be conducting business with any disqualified persons where the transaction involves selling or exchanging or leasing property, lending money, or extending credit, furnishing goods, services, and or facilities. So the main objective here is to make sure there's no self-dealing. I know some clients may feel, well, it's my money, I should be able to do what I want. Well, keep in mind, the self-directed plan has its own separate tax ID number. So there's one of the components that's set up with retirement account. You have some form of asset protection, meaning that until you turn the age of 59 and a half or retirement year and you start to take a distribution, those funds are yours but not directly yours, and there has to be an arm's length transaction rule set in place to make sure that you're not using any of those funds for any immediate or present benefit. You're usually to use those funds once you retire and actually after you've taken a distribution. So the key rules here is no self-dealing, no personal use of funds until you hit the retirement age and or have taken a distribution, in which at that time, if you're under the age of 59 and a half, there's a 10% early distribution penalty. If you're over the age of 59 and a half, the only thing you're subject to is to pay the taxes at whatever your ordinary income tax rate may be as the individual. So disqualified persons, once again, we're talking about prohibited transaction, who you can and cannot do business with when it comes to using a self-directed plan. Examples of disqualified persons would be you as the account holder, including your spouse, that included lineal ascendants and descendants, including their spouses, any fiduciary of the IRA, so that includes if you're working with your CPA, financial planner, anyone who wants to take part in an investment deal with you because they have a fiduciary capacity over you and or maybe your IRA, they are considered disqualified parties and cannot take part in an investment transaction along with you and or your IRA. anyone providing services to the IRA, so that will be including us as the IRA administrator and or custodian, corporations and partnerships, trusts, or any entity as to where the individual and or the spouse owns more than 50% ownership, controlling interest, ownership interest in that entity, you're considered a disqualified party. And why does that come up? That question comes up because there are individuals who, opposed to going to a bank, may own a business, and if they meet the rule of not owning between themselves and any other disqualified person, such as a spouse, does not have more than a 50% controlling interest in that company, they can actually loan money to that business that they own. So it's really important that you understand those rules. For more information on that, give me a call, and if necessary, you definitely want to get into detail on how that works. If that's something you're considering, is definitely sit down with your CPA and or tax professional and examine the rules and the structure of your transaction to make sure that the transaction will be compliant. So in essence, what the rule is right now, we all know that our government is teetering on the cliff of being broke. So you want to make sure that you're not basically circumvent any rules and trying to perform any form of self-dealing, because as of lately, there's been a lot of changes and scrutiny over the self-directed IRA industry, and I'm sure a lot of that has to do with basically the IRS and our federal government looking to capture as many or as much as tax revenue as they can, and they're looking for tax cheats using this investment vehicle as a source to be able to raise additional revenue in terms in the form of taxes. So they will not think twice of disqualifying your account, taxing you, and if you're under the age of 59 and a half, assessing the 10% early distribution penalty. So definitely follow the rules. If you're not sure, give me a call. I'll give you as much information as I can in terms of education. Once again, we're not in a position to give you any advice, whether it be tax or legal, but I'd be happy to also discuss with any tax professional and or legal professional your transaction and what your options may be to move forward with your investment. So once you've established your account, you got to basically fund your account. So the methods of funding a self-directed plan is either of the four options. The first one being a transfer is usually the method when it comes to transferring or moving funds from one IRA over to a new IRA, and it's a non-taxable event. Usually the transfer process takes anywhere from 7 to 10 business days. Once the funds are basically received, whether it be via check or wire, you're available, the funds are available for you to make an immediate investment. The rollover is usually the method of moving funds via either an IRA or a employer-sponsored plan, such as a 401k, 457, so on and so forth. That method usually can be a rollover, and that could be a direct or indirect rollover. That rule is usually you have 60 days from the date that those funds are dispersed from the current custodian, that you have 60 days to get those funds into another retirement custodian to avoid any taxation and or penalty. So keep in mind that the clock actually starts from the date that those funds are dispersed and or from the date of the check that is basically cut. So it's really important when you receive that check is to take a look at it, make sure that you're counting from the date of the that's on that check in terms of your 60-day period to make sure those funds are deposited into another retirement account to avoid taxation and or penalty. The process for rollover sometimes could be, in terms of the timeline, could be anywhere from 7 to 10 business days. It really depends on the custodian and what their process and procedures are when it comes to rolling over funds. I've seen some situations where a rollover could actually occur faster than a transfer. But keep in mind, one of the problems with the rollover is it's rare that the custodian will roll over funds because of the IRS reporting via a wire. Usually they want some kind of paper trail, so they will not wire the funds. They will always issue a check. And the problem with that is if this is a time-sensitive transaction, all custodians, because of the size of the checks, usually there's a mandatory business hold, 3 to 5 day business hold on all checks received. So once again, if you're going to do the rollover, look at the timetable when it comes to your transaction closing and consider either transfer or rollover. Once again, if it's a 401k or an employer-sponsored plan, you have to go with the rollover. If it's an IRA, you have the option of a transfer or a rollover. The other method of putting funds into the account would be a contribution, and that's going to be relative to the account type, and you have a maximum amount based on the account type that you can actually place out-of-pocket funds into that account on an annual basis, and we'll talk about that on the upcoming slide in terms of contribution, what your limits are, and so on and so forth. And lastly is conversion. For those who are concerned about where the tax rates will be in the far or near future, A Roth conversion is something that's pretty popular with a lot of our clients, where you're basically converting tax-deferred funds from either a 401k or any other traditional SEP or tax-deferred IRA into a Roth. The benefits of that is you pay taxes based on today's rates opposed to what they may be in the future, and as long as you're at the age 59 and a half and you've had the Roth for 5 years, you pay no federal income tax on any growth that you realize on the investment. So that's something that's giving a lot of our clients peace of mind, not knowing where the tax rates are going to be just based on current political situation in our country. So once again, that is another option available to you in terms of funding. So the different types of accounts that's available for self-direction, once again, all of our plans are self-directed, but you have different plan types that are in accordance to IRS rules and guidelines. So pretty much the same rules that you're following based on any of these plans that you see here on the screen that you may have with existing custodians. All the rules are the same in terms of contributions, so on and so forth. So as I mentioned earlier, you have tax-free and tax-deferred accounts. Your tax-deferred account, which is one of the more popular accounts for those who are usually W-2 and or self-employed, will be a traditional IRA where your contribution limit is up to $5,500, and if you're over the age of 50 and a half, you can contribute an additional $1,000, which takes you up to $6,500. The Roth, same contribution limit, same increase if you're over the age of 50 and a half, an additional catch-up $1,000, taking you to $6,500. The difference between the traditional and the Roth is, once again, the Roth, after 5 years and 59 and a half, you pay no taxes on the gains that you realize. Once again, with the Roth, unlike any other tax-deferred account, there is no required minimum distribution at the age 70. So once again, this is something that a lot of our clients are looking at. It's not for everyone. If you're investing and you have limited capital, because you do have to pay tax on whatever the conversion amount is if you're converting. But if you're making deposits into an account via contribution, you've already paid taxes on that. So any monies that you're depositing via contribution have already paid taxes on it. So any growth that you realize based on that is tax-free as long as you don't pull it out prior to the age of 59 and a half and you've had the Roth at least 5 years. The SEP IRA is a tax-deferred account for those who are 1099 or self-employed, and you have a contribution limit up to $51,000. Once again, this is a great plan. It's the equivalent of a traditional IRA, but once again, it's for those who are 1099 or self-employed. You have a much higher contribution limit than those who are using a traditional or Roth IRA. And of course, it's unfortunate for those who are W-2, you don't have access to that SEP IRA. The rule is, once again, 1099, self-employed, and your main source of income is from either 1099 or self-employment, because I know I have clients who have both 1099 and W-2 income. The rule is your main source of income determines as to whether you can make a contribution to that SEP. So I have some professionals, whether it be real estate, tax, or legal professionals, and they have both 1099 and W-2 income. So what they will do is usually set up both a traditional and a SEP IRA. So depending on what their main source of income is for that particular year, 1099 versus W-2, will usually dictate in terms of which plan they're going to make a contribution into for that tax year. So if they've made most of their source of income through 1099, it's obviously the best option is to contribute to the SEP for that particular year, because you cannot contribute to both in a calendar year to exceed a certain dollar amount. So if you want more information on that, I'd be happy to answer any questions. The Simple IRA is another employer-sponsored plan where if you have a small business and you have less than 100 employees, this is a plan that's the equivalent of a 401k, but on a more scaled-down model where your contribution limit is up to $12,000. A 1K or solo K is pretty much a hybrid between a 401k and a SEP IRA. This plan allows you to contribute as both an employer as well as an employee. It's usually for those who have a small business, a partnership, a husband and wife owning a business basically can qualify for this plan to make this contribution. And once again, it's a great plan to where, unlike the other plans, the IRAs, so to speak, the 1K or the solo K allows you to be able to borrow against those because it has a 401k component. So if you need to borrow against those funds, that's an option that you have available to you, because I know the question comes up, well, if I had to choose between a 1K or a solo K and a SEP, both contributions are equivalent, why would I go with one over the other? One of the key features would be is that you can borrow against the 401k where you can't with the SEP. In addition, if you're going to be taking out any kind of non-recourse lending, the solo K or the 401k has an exemption against what's called unrelated debt finance income tax if you're going to be using any form of leverage. So that's usually the determining factor as to whether one would go with a SEP versus a solo K. So pretty much going to wrap up the presentation. The first step you're going to take is to go ahead and establish your account, your self-directed account, and you definitely want to consult with your tax professional if you're not sure what plan is going to be best for you. Usually that's something that's determined by your tax professional if you're going to be changing from the current plan type that you have to a new plan type based on whether you're 1099 W-2. There's a lot of variables that you want to consider before you maybe transfer the account type from what you currently have over to something different. You definitely want to consult with your tax professional. Once the account's established, you're going to fund your account via transfer, rollover, or contribution. If you're going to be investing in life settlements, what you're going to be doing is completing what's called an intake form. It's a very simple process. We have some internal forms, about 2 or 3 documents, which are authorization forms, where you're going to complete those forms along with an intake form, usually wire instructions from Reliant, whoever they're going to be assigning those funds to for the investment. And usually within 2 to 3 business days, you're ready to go, you're funded. It's that simple, unlike maybe what you're hearing from your current custodians. It's convoluted, the process is overwhelming. It's really pretty simple, and that's what I'm here, as well as my staff, to assist you through the process. So if you have any questions, feel free to give me a call. Here's a flow chart to kind of give you an idea how the process looks from opening the account, funding the investment, and so on and so forth. So in summary, IRAs can hold all types of investments, not just securities or traditional investments. Partnerships and split ownerships are allowed using this investment vehicle. IRAs and solo K plans can grow either tax-free or tax-deferred, so you definitely want to consult with your tax professional in terms of what plan type is best for you. All plans qualify for partial transfers, and conversions are allowed. So for those who are looking to maybe consider moving a portion of all of their funds, with an IRA you have the ability to move all or portion of your funds. And if you're looking to convert from a tax-deferred account to a tax-free account, you have the option to do a partial or a full conversion, whatever you feel that you can stand or whatever your tax professional recommends is best for you. One of the main key components here is that you want to make sure you establish the account. Some transactions are time sensitive, and you are required to enter into contract under the legal vesting of the IRA or 401k. It's prohibited for you to enter into contract under your name and then transfer it to the IRA and or 401k. So it's important to at least establish the account, get your account number investing established so you can enter into contract. We can always get the funds moved over later, but at least getting the account established allows you to go into contract almost immediately. So with that being said, that's pretty much my presentation. We're going to open it up for a Q&A session. Here's my contact information if you have any questions relative to what we covered today, whether it be about the plan types, the different investment types, how do you actually get set up to make an investment in a life settlement, what our process and procedures are, fees and whatnot, please give us a call. So Ken, are you there? Ken and Corey are going to go ahead and start answering some of these questions.
Yes, we are.
Yep.
Okay. Let's see. The first one is, what are the key reasons an uninsured, or should I say an insured, would basically sell their policy? So for those who are 80 plus, they're asking what's maybe 3 to 5 reasons why an insured would sell their policy?
Well, as a broker, hey, Lamarr, it's Corey. Yeah, as a broker, what I saw overwhelmingly, I would say probably 80% of the cases that I saw were that, usually a lot of these policies were sold by an agent who no longer works with the client. They haven't gotten the proper advice for a long time, and most of these assets were distressed assets where there was not enough cash value in the policy to pay premiums, and the policy was in danger of lapsing. And that's what we see a lot of the time. Another reason why an insured might want to sell a policy is maybe their situation has changed. Their estate planning situation has changed. Legal changes is the third. Laws changed. The estate planning laws in this country have changed quite a bit in the past few years, making policies unnecessary. So that's another reason why. Ken, can you think of some other reasons why someone would?
Well, again, just we see a lot of people that have been hurt financially in the markets, and where they were planning to make their premium payments, they knew they were escalating, and they knew what the premium payments would be in years coming, but now they can't afford to make those premium payments, or they've just lost the usefulness of this policy. Their children are grown, they're well off, they have multiple policies, and they want to sell one in the secondary market to live their remaining days with dignity.
Yeah, and also I've seen as a broker, I've also seen many, clients and investors, insureds that have had term insurance policies that were at the end of their expiration period. So, for example, someone buys a 20-year level term policy at age 55. They're now 75, and the policy is going to expire anyway. So often what the agent would do is they would convert that policy to universal life, and then we would go into the market and sell it. And instead of just dropping the policy and getting nothing, often the insured would get back a large portion of their premiums, if not all, plus make a profit. And we also see a lot of corporate policies as well. Often a key man will retire, and a corporation will have no use for this term policy, and that will often be converted and sold as well.
Yeah,
so there's a lot of uses. A lot of it depends on advanced planning that a lot of the agents do with their clients, but we see a lot of different reasons why someone would want to sell it.
Got it. Okay, the next question is, describe your vetting process to ensure there are no contesting of the policy by the relatives when the insured becomes deceased. And I get that a lot over the years handling investments in life settlements. That is one of the key questions, is any contesting of the policy at the time of death.
Okay, Lamarr, this is Ken. When an insured wants to sell their policy, when they sign a HIPAA compliance form, we pull all the meds and everything. We see it's a sellable asset. Once we make an offer to the insured and they accept the offer, then the legal documents will be presented to them. In there's a change of ownership, change of beneficiaries. So the beneficiaries sign a waiver off the policy. We make sure that the insured is of sound mind. We get a physician statement stating the fact that the insured is of sound mind, and we just pretty much go through the, go ahead, Corey.
Yeah, I mean, we just really go through the same process that the institutions do.
Right.
This business has been going on for 15 years or so. We do the same thing that Credit Suisse and Deutsche Bank and Goldman Sachs do. It's a valid concern, and you're right. It has to be structured the right way legally, and that's kind of what we bring to the table is the expertise and the experience in the asset class to help investors do that. So it's a valid question, but, believe me, if this was a problem for the last 15 years, the institutions wouldn't be buying policies.
Got it.
For sure.
Well, here's another question somewhat related to the last one, and this one is more or less relative to any fraud. So in this case here it says, how are investors protected against fraud and or contested claims by the insurance company? So if there's any kind of reason that the insurance company feel there's foul play and as a result of the death, has that ever happened as it relates to any of the policies?
Well, the policies that Reliant is buying, what we do is we go back to the original application for insurance. We pull that. We have a law firm out in Irvine, California, Irwin Legal. They have been in the asset class for close to 15 years. And what they do is they have a department that investigates every policy that we're interested in buying, and they research it for fraud, signatures, doctors, evaluations, medical records. I mean, everything is thoroughly scrubbed on the policy.
Yeah, and the other thing to realize as well is that typically what we like to do as a company is we like to retain a very small ownership of the policy because we buy the policy and we, provide that policy to investors piece by piece and sell fractionalized shares of that policy. But while we own it, we own it. So, we have to make sure that it's certainly a viable asset and something that's not going to be contested. And we typically keep anywhere from a 3 to a 10% interest in that policy, investing alongside with the investors. So we've got this game as well. So hopefully that answers the question.
Okay. And the next question is where does this investment rank among some of the more popular Wall Street investments relative to principal preservation and risk of loss?
Okay, I'm not sure I understand the question, but, basically there's been some independent research done by Conning Research and Bernstein. Bernstein Research has said that this asset class is predicted to grow to $160 billion by the year 2030. So, I guess if you want to put that into perspective, I'm not sure exactly what you would be comparing this with. But, the asset acts like a zero coupon bond. So, it's something that a lot of the institutions and hedge funds and private equity firms are invested in. But, in terms of actual numbers as to, percentages and, how it compares with other investments and what else they're investing in, I'm just not sure I understand the question.
Well, it's certainly uncorrelated, so it doesn't matter if the market goes up, down. This asset class will perform because, let's face it, we're investing in insureds that have life insurance policies and life expectancies of upwards to 8 years. So, and there's never not been a life insurance carrier that's ever failed to pay out on a death benefit proceeds. So I really don't know how you can compare our asset class to a stock, bond, or an equity.
Got it. And that's a good answer. And actually, and that's kind of where I think we're going with this here is you really want to actually, in your advantage, is to really contrast that investment vehicle to some of your traditional investments. As you mentioned in your presentation earlier, there's a lot of external forces that could affect the volatility of that investment as it relates to political, social, economic, a lot of different external factors, both internationally as well as nationally, where this investment here, based on the structure, is one of those investments that is not affected by those external factors.
Absolutely.
So the next question here is, and I'm not sure if you guys have followed this industry a lot here. As of yesterday, I know it's something that was published in terms of we're getting closer to finalizing rules by the SEC for crowdfunding. How do you think new crowdfunding rules will affect the life settlement industry as it relates to buying policies, so on and so forth?
I don't think it will at all. You know, crowdfunding is more of a venture capital / private equity type situation where small companies that couldn't get funded typically can now get funding from investors. So, you know, unless it relates to other life settlement fractional companies like us getting funded, I'm not sure that I haven't heard of any crowdfunding to buy policies. Again, you know, you have to understand that when an investor wants to go and buy a policy, there's a lot that goes into it. So they really would need professional advice, which is kind of what we offer. So I haven't heard of any crowdfunding. Have you?
No, I haven't.
Or any regulations regarding crowdfunding with respect to life settlements? No.
Not to respect the life settlements.
No.
Okay. And one question looks like this one is probably something I can answer, and you guys can chime in as well. It says, considering a life settlements are an insurance product, isn't it a prohibited transaction using retirement funds to invest in this product? And my answer to that question is the IRS Rule 4975 prohibits you from investing directly into an insurance product. Keep in mind that you're basically investing or buying in fractional shares into a policy, so you're not actually named as the beneficiary on the policy. Usually the trust usually is named as whoever's purchasing the policy, where once again, using the self-directed plan, almost equivalent of buying stock or private shares, you're basically going to have a fractional share or interest in the ownership via a certificate in a life settlement. That makes it a permissible transaction because, once again, the self-directed plan is not making a direct investment into the policy.
Yeah, and Lamarr, just to add to that, it is trust-owned. The Reliant Life Shares Trust owns the policy. It is put in trust with Christiana Trust, which is a division of Wilmington Savings Fund Society Bank. They are issuing a beneficial interest certificate upon the investment being maturing. Right.
Got it. And it looks like we have about one or two more questions that we have time for. I think you guys just touched on this, is what is the average life expectancy of the insured? I think you mentioned like 8 or 10 years is usually the life expectancy.
Well, if you take all the policies into consideration, I think it's about 5.8 years on the average.
Okay. And if in the event that, and I'm sure based on how you guys buy your policies, because they're pretty diversified in terms of different policies, in the event that an individual would live beyond the life expectancy, who pays the additional premiums?
Okay, that's a very, very good question. What Reliant Life Shares does is they go ahead and they'll warehouse up to the life expectancy plus an additional year in most cases. If the insured outlived the projected life expectancy by more than the premium reserves that were set aside for that specific policy, if the investor owned, let's say, 1% of the face value of the policy with their investment, they would own 1% of whatever the premium was due that following year. They would receive a letter, a phone call from Christiana Trust stating to the fact in 90 days you have to come out of pocket for $316 to keep your portion in the premium, to keep your position in the policy.
Got it. So basically, whatever their percentage of ownership is would determine what percentage of the premiums they would have to pay.
Yes, and again, we're reserving a year beyond the life expectancy. And again, if any policy outlives, we try to get anywhere between an 18 and a 20% projected annualized return back to our investors. So even if the policy goes 2 or 3 or 4 years beyond the life expectancy, even double the life expectancy, I mean, typically it's right around an 8 to a 10% annual percentage yield. And I ask all of our clients, would you be upset with me if your parked funds in your investment portfolio was just to average around a 10% or a double-digit return? And the answer comes back, and they're saying, no, I'm not. I like the security in this investment.
Got it. Well, unless you guys have any additional questions, like we've run out of time here. Great discussion. I'm sure we're going to get more calls as well as emails. I've actually seen some more questions come across, but it looks like we run out of time. I want to be respectful of everyone else's time who've actually joined the webinar. Any questions that we couldn't answer today, feel free to give us a call or email us. Here's my contact information. And Corey and Ken, go ahead, if you can go ahead and give them your contact information again as well.
Do you want to go ahead and put controls over to me, and I'll post it?
Okay, hold on here. Okay, here we go.
Okay, so you should have everything there. The phone number, we're based in Los Angeles, California. And you can feel free to call our office, and we'll answer any questions. We can set up one-on-one private call, webinar information, DVD, send out a brochure, DVD, video, 24-minute video.
Okay, well, I'd like to thank everyone for joining today's webinar. Both Ken and Corey, I thank you guys. Great information. And once again, this is a great investment vehicle for our listeners to consider, once again, to further diversify your investment portfolio. I want to thank everyone once again for joining, and have a great day. Feel free to give us a call or send us an email. Thank you.
Thank you.
Thank you, Lamarr.
All right, goodbye.